This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
A large pile of macro data is overwhelmed by the headline sound bites this week, but the market seems to, while struggling to digest it all, largely powers through it and heads higher. On the show this week, we pick through it as best we can and then dig into an update on one of our core holdings. Welcome to the Wise Investor Show podcast. I'm Chase Hinderstein. It's a fun week to try and create an overall narrative for the podcast. There's a lot of news to get through, and I'll have a bit on a holding in our core portfolio later on. But before I get bogged down trying to unpack some of the political rhetoric that's affecting the markets, let's look at the headline macro facts that are really the core focus. We got core inflation data this week. And while I still think the odds of a rate cut this month are, let's say less than zero, which means what it sounds like, that is not my base case, but the window is ajar enough to create a bit of airflow there. But Wall Street has the odds of a rate cut this month basically at zero. So any rate cut would be taken as a big surprise. The consumer price data was released this Tuesday for the month of December, and it was during a quarter with a lot of moving parts, including a prolonged government shutdown. But the headline number was 2.7% inflation year over year, a tenth higher than the consensus estimates, equal to the previous reading, but the core rate was 2.6%, and that's a tenth below the estimates. The core was also at 0.2% for the month-over-month reading, also a tenth lower the estimates, which is one element that opens that window that I'm talking about. Now, this can be paired with last week's unemployment data for the December period, which showed only 50,000 jobs created, below the estimates, and that's not enough really to sustain current unemployment rates, although the headline unemployment rate notched down to 4.4%, which was versus the estimate for an unchanged 4.5%. And there was actually a very big leap in productivity, which the market's like. So not enough here for the Fed to be alarmed and really race for an interest rate cut. But some push and pull on the decision-making, along with what was the JOLTS jobs openings report that came in below expectations. So they could get deeper into the weeds and maybe see the need to juice the economy up a bit. Although I've also heard the argument made most recently on TV from a former Fed governor that where they think we're already in his estimation, below the neutral rate, and that we are already in accommodative territory here. And in reaction to the data, the folks over at Strategis on Tuesday said that skipping a move in January was already likely, but the other news in the headlines and the CPI data could result in this January skipping the month in this cut cycle. But really, they think now they're getting more hawkish, saying it could be morphing into more of a pause where the Fed doesn't act not just through the March meeting, but beyond that. Now, one part of the bevy of political news affecting these decisions this week was an announcement on Monday that the U.S. would immediately impose a 25% tariff on any of the nations that do business with Iran. Now, it remains clear if this tariff is in addition to the existing tariffs, say, that we have on China and various nations, but at its word, this would be applied to China, India, United Arab Emirates, and other U.S. trading partners who do a lot of business with Iran, and holds the potential to derail some of the ongoing trade negotiations, as well as extending the narrative, which I've shared on this podcast, that the tariffs imposed in 2025 would now be in the rearview mirror as far as the inflationary data. And instead, this may contribute even more this year if we saw an additional 25%, especially if businesses do move forward as expected now, passing along more of the costs of these tariffs onto the store shelves instead of consuming it themselves and carrying the costs, as many of them chose to do last year. The Iran story, of course, is really fluid, and by the time you hear this, we might have a supportive resolution to the turmoil that's defined the start of this year, or we could see direct U.S. military involvement, both of which would make these very, very dated statements on this podcast. As of Wednesday, though, the White House has seemingly backed away from military involvement, and it seems that there's no further news at all about the 25% tariffs, which were supposed to be applied immediately. They did announce some additional direct sanctions on specific individuals over there, but that's not really pertinent to the markets at all. What we are waiting on, and with my luck, I expect it'll be announced while I'm recording the show, is that the Supreme Court is soon going to rule on the legality of the existing tariffs that have been applied. And the simplest outcome there is that they rule that the tariffs are legal and that they can stand as applied, while if they instead overturn them, then we'll see a lot of action, perhaps in the form of refunds of what was already applied, and it's not clear how that would unfold. And that is ostensibly could be deflationary, as a lot of cash would then be returned to corporations. But ultimately, the expectation is that they would, if they are overruled, the tariffs would then be reapplied in some other fashion as the administration tries to navigate any adverse ruling here. Of course, some of the biggest headlines of the week came from the criminal investigation of Fed Chair Powell for lying to Congress regarding the renovation of the Federal Reserve's headquarters. And this has resulted in a long queue of talking points on both sides, although the divisions here aren't necessarily along party lines. They're kind of broken up, but those falling in line behind Powell, including former Fed chairs, a handful of global central bankers, speaking about the importance of the Fed's independence, and current politicians of both parties supporting Powell, while others supported the investigation, pointing to no one being above the law, which was an interpretation of Powell's response, and looking for clarity ultimately through what testimony may arise. Regardless, this spectacle has to some degree chipped away at confidence in the banking system a bit further and may upset ultimately the transition of Powell's seat as chair to the next chair when that time comes. Also in the headlines in this hectic week, a proposed cap on credit card interest rates, which again split support on the lines of various agendas and in some cases divided party allegiances between those who see banking as a necessary evil. They like to demonize the banks, and those who see any attempt at capping interest rates as a threat to the availability of credit to the economy and to the consumers who use it. And that did ding up the bank stocks a bit this week, many of the biggest of which actually announced their fourth quarter results also this week. But while the results overall were generally benign, it was this news from the government that really owned the day and drove those stocks a bit lower. Raymond James' Washington policy analyst, Ed Mills, wrote in his analysis that the president does not have the authority to impose a cap on rates, but that there's a risk that this talk could lead to the legislation that would be required to impose such a cap, which could act to cut off credit to the same borrowers that the president is trying to help here. Now, in previous debates on this very same topic, the idea of having an interest rate cap, especially one that ultimately led to landmark legislation in 2009, it was ultimately decided then that the negative impact of such caps was too large, and instead of using them, it led to the creation of the Consumer Financial Protection Bureau, which acted to impose limits instead on late fees and some seemingly predatory practices by the banks, but left no cap in place. But that bureau itself now has more recently been partially picked apart. So while there's a lot to unfold, and most of this is just setting the tone for interpretation of really what's going to be coming out that will be more tangible in the next few days or next week. Before I take a short break, I will point out that today, the secured overnight financing rate, SOFR, which is basically the base rate that has replaced LIBOR as a widely used benchmark rate for blending, it's a rate that's used for trillions of dollars in borrowing in the United States, what many corporations use for their floating rate debt. It's at a 52-week low right now. It's at 3.65% versus a 52-week high of 4.51%. So corporate borrowing, by that measure, has come down quite a lot. The prime rate, also a big component of corporate borrowing, it's at 6.75% versus its annual high of 7.5%. That affects a lot of corporations and consumers. and it's at the 52-week low. And the 30-year mortgage rate in the United States now, the average rate is at 6.2%, another 52-week low, down from a high of the year of 7.34%. And with many other forms of mortgage rates now seeing interest rates below 6% for borrowing, some mortgages are actually coming in below 5% on some hybrid loans. There's a lot of liquidity in the system right now, and these lower rates are facilitating investment both in homes and in businesses today more than they have over the past few years. And with lots of catalysts that can drive asset prices higher here, well, it argues for a strong economy, a strengthening economy, and stronger growth if we can navigate some of the chicanes that we're coming across here in the headlines. All right, I am going to run into a quick stop here, but I'll return in a moment with an update on one of our core holdings in the portfolio. For the Wise Investor Group, I'm Chase Hinderstein, and I'll be back in a moment.
AI stocks still dominate the market, but valuations are almost back to dot-com bubble levels. How should you balance participation with diversification? Tune in every week as we discuss the latest financial trends and how to become a better informed, wise investor. Listen to us at The Wise Investor Show at RaymondJames.com/The Wise Investor Group, or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. An update today on Danaher, symbol DHR. It's been a core holding in our portfolio for many years, which means that I own shares myself and we own it for our clients, so I have a positive bias on the name, and you should interpret what I'm saying here with that in mind. But ironically, I'll first start off by saying that it doesn't have the same amount of luster it once did for me. Because about a decade ago, we looked at it as this diversified holding company that owned many businesses across different industries that gave it a broad exposure to the economy, and I felt that offered a great balance. Some areas would shine while others may lag. And it's always had these characteristics. It always had the tendencies to be acquisitive. Danaher's always made acquisitions. They'd roll purchases under their roof, under their umbrella, and they'd plus up the productivity and profitability of these purchases by both offering scale as well as driving higher efficiency and often profitability by applying their trademark Danaher management system to these various holdings. They also have had a series of spin-offs over the year where they've unleashed value by spinning off. They released some of the names that they had built up over the years, and they spin them off as their own standalone publicly held names. And then more recently, they've used those spin-offs as well as the subsequent purchases they've made to make the overall holdings that they still have more focused solely on the healthcare life sciences business rather than a mix of various industries. And that's great if the life sciences outperform the overall economy, but that also cuts both ways. And during the COVID pandemic, their businesses flourished initially, especially diagnostics, because the demand for these diagnostics, the testing supplies essentially, and the equipment they've developed to sell to drug companies to support the development of new therapeutics were greatly in demand. But as the pandemic wound on, inventories at their customers built up, and the growth in drug development slowed around the world, and Danaher stock has languished over the last year. Hopefully that's about to turn a corner, as the long-term trends for spending in the life sciences space are expected to ramp up with China coming back online in a big way, and the Western markets increasing their efforts in biologics and modern therapeutics. And last week, this was a feature article in Barron's, who printed an article titled, "This stock is ready to put its post-COVID malaise behind it," end quote, focused on the now depleted inventories from Danaher's customers and hopefully some clarity and resolution through the tariffs, which they had to navigate last year, which, as I said earlier, remains to be seen right now with the Iran news, but that's largely being discounted today. Barron's cited an analyst, one who I'm not particularly familiar with, who said that pharmaceutical R&D spending should be increasing right now, and that Danaher specifically has a lot of exposure to the market for developing monoclonal antibodies. I'll get back to that later on and try to say it better. But they're expecting the demand for these biologic medicines to continue growing now by double digits year over year. And in their own presentation that Danaher had at a big healthcare conference this week, they announced that they expect their results for the fourth quarter, which are due to be released later this month, actually will be ahead of their previously shared expectations, and that their full-year results will be toward the high end of their previous guidance range. And the stock took this, of course, positively, and it's now trading about 5% higher so far for this calendar year. And they also went on to point out that they have, quote, meaningful capacity available to pursue value creation opportunities, end quote, which means that they have a lot of cash on hand, and Danaher's once again on the hunt to make new acquisitions. And that reminds me, which I've just quoted this before over the years, but it reminds me of this conference when I saw them first time 10 or more years ago, where their CEO at the time, and this was a time when there was a concerns about an overall downturn in the economy, and he got up there and said, well, if there is some weakness in the economy, it'll actually be to our long-term benefit because we have a lot of cash on hand and it'll allow us to make acquisitions at more attractive multiples. And they anticipate their current position to generate years of high single-digit revenue growth now, along with double-digit earnings growth. Danaher made a point of emphasizing that demand is being driven now by, of course, globally an aging population. Also, that the biologic drug pipeline is, quote, chock full, according to their current CEO. And he pointed out that Alzheimer's, as an example, which while there are hopefully better treatments and successful treatments on the way, either way, it's the ongoing and expensive pursuit of those treatments that powers Danaher's revenues. While the diagnostics business remains pretty strong, that's the one that was flying high during the pandemic, it's the recovery in the bioprocessing business, which Goldman Sachs focused on recently as a potential upside catalyst. Led by Cytiva, this is a company that Danaher bought from General Electric in 2020. They took General Electric Healthcare, rebranded it Cytiva. They paid over $21 billion for it. And that company provides the technologies that are used to develop the therapies and used to develop vaccines. And Danaher now estimates that they have a stake in over 90% of the global development of monoclonal antibodies. While that area has been flat over the last year, Goldman notes in their report that recent activity with the company, including indications from Danaher's customers, some of which are looking to reshore their facilities and others that are just simply looking to increase their capacity, they believe that the space has been at a trough in this business cycle and that the risk to the low single-digit growth estimates that Danaher is providing, the risk is actually to the upside in those numbers. And after the conference, an analyst at Stifel noted that the bioprocessing is now expected to drive performance, but diagnostics has also good momentum, and life sciences has increasing sales. An analyst at William Blair, their analyst, wrote that the valuation is at a historic discount and that, quote, with superior organic growth and capital deployment, we're maintaining it as a best-in-class large cap, end quote. So their best-in-class name for large cap growth for the folks at William Blair. So while I look back with some regret at the days when Danaher operated as this kind of holding company with many, many businesses, the stage actually may now be set to start rewarding the shareholder again, as Danaher sat out 2025. But now they are at a point where it's relatively cheap, it's cash rich, and they could actually see the tailwinds picking up for this more myopic focus in their business. All right, that's a wrap for me this week. Unfortunately, I think that the next 48 hours or so has a lot more relevant news than I have for you today, but we'll see what next week's podcast have. We still haven't celebrated that Dow 50,000 hoopla yet, although we're once again knocking on that door today. And there's this turmoil in the news, and while only some of it may ultimately affect corporate earnings, all this news does give us pause at times, and that's the collective us. So please know what you own and be mindful of risk. For the Wise Investor Show, I'm Chase Hinderstein. Thanks for tuning in.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.